Well, hello and welcome to another video by Financial Ernie. On today's video, I want to talk to you about Terawulf. That's right, folks. I'm talking about the Bitcoin mining company, not an actual wolf here. I would like to talk about one of their latest PRs that was just released within the last week. It has to do with a $500 million type of secured note. I'd like to talk about the pros and the cons behind that note and why I believe it is an actual bullish decision by the company. So without further ado, let's get right into it. All right, and as I mentioned, this PR was for a little less than a week ago. It was put out October 25th, 2024, and the title is Terawulf Incorporated announces closing of a $500 million 2.75% convertible senior note offering. So we're going to go over a little bit of the details for this specific offering and why I do believe that this was a bullish move by the company in terms of protecting the existing shareholders, the existing investors, and we'll talk about that as we kind of move along. I like to break down specifically the numbers for this transaction, and then I'd like to talk a little bit more about the market mechanics behind utilizing a tool such as these senior convertible notes with some of these other ways that companies will hedge against dilution. So let's go ahead and jump right into that. So the first thing that you're going to want to notice is this convertible senior notes has a maturity date of 2030. So if you think about it, the investors that are fronting the money are putting it in some way that you may consider putting money into a bond, where you're tying up your funds now, but you're expecting a decent amount of return. Now, you may be thinking, why would a company invest this much money for only 2.75%? And there's actually two ways that investors utilize this note to be able to increase their funds. We'll talk about those two types of investors as we kind of move along and to go into more of a generic understanding. But before we do that, again, I want to go ahead and break down some of these key points. So the first thing you're going to notice is that Terawulf did decide to put in a capped call transaction. And what that ended up being is a 100% above the current share price of the day of this transaction, which was at $6.40. So this capped call is at $12.80. So now that you kind of understand some of those numbers, they went ahead and provided a graphic that would explain a couple different ways they've highlighted how this will not have a large impact on the current shareholders in the form of dilution. So let's go ahead and talk about that. And again, we'll break it down a little bit into some more of the generics. So as I mentioned, the first thing that they highlighted was the fact that they purchased a capped call. This neutralizes dilution on the stock price until it's 100% above the reference price, which again, the reference price was at $6.40. So at 100%, you're looking at $12.80. So the company, as number two, they went ahead and repurchased 17.97 million shares at $6.40 simultaneously with this convertible offering. So what that does is it immediately reduces the overall share count by 18 million. And then because of this capped call that they have, they're able to utilize that call for the cash as the share price continues to increase until it hits $12.80. At that point, the call is capped. That's the most that they can make off of this specific transaction that they did, whether it be with a market maker, institution, or whatnot. And then as the price continues to increase from there, you have to remember they already purchased 18 million back. So you're going to start to see 18 million shares kind of get back and get neutralized back to zero. And then they talk about that, how once it hits $18.41, which is a 188% above the current price of the stock, that is the time that the investors, the current investors, would then notice some of the dilution. So you'll start to see an increase of the current share count at that point in time. And again, at that point in time, we're talking about an almost 3x return for these investors. So again, I think that this is a very bullish way. This is a way to show that the company has confidence behind the fundamentals, as well as confidence in where they believe the share price will be going. So it'll be interesting to look at the SEC filing to see if they give any additional information about the investor themselves, to understand if they are doing more of a long-term investor or if they're looking more of a short-term investor. And we'll talk about the differences between those two as we continue on. The next thing I want to talk about is the fact that this specific offering is convertible and it's callable after 3 years. So in the event that the price reaches 130% of the conversion price, which is at $11.02, and it's been 3 years, the company can go ahead and basically cash out on this senior convertible note and pay them in full, and basically stop that additional conversion rate for the remaining shares and kind of go ahead and clear out this entire loan. So they have the option to go ahead and pay the loan off early. Again, it has a maturity date of 2030, but they have the option to pay it off as early as November of 2027. So we understand how they tried to put together a couple different strategic levers, if you will, to kind of help reduce any kind of dilution impact. But how did they come up with the funds for that? So let's talk a little bit about that. So after you take out the discount that the investor received, the company got $487.1 million for this offering, and they're expected to use the first $60 million to pay for that capped call transaction that we talked about. And then they're planning on paying $115 million to repurchase the shares of their own stock. As we talked about, they're going to purchase 17.97 million shares back out of the float. So again, after those two amounts are taken out of that 487.1 million, they're going to use the rest of those purchases for general operating purposes or general corporate purposes, which could include their working capital, strategic acquisitions, expansion of data center infrastructure to support high performance computing activities, and or expansion of existing assets. And again, you have the opportunity to kind of look through some of their previous filings, understand what their revenue looks like, what their cost of revenue came in at, and give you an idea about what kind of percent profit margin they have. So then think about that, subtract the 2.75% for this discount, and you can get a good idea about what kind of return on investment they could do just by scaling up their current operations, adding some additional mining capacity to their current sites. It'd be very interesting to see what they do choose for this. So we'll have to see, but I do appreciate the CFO taking the time to really put together a very strategic way of getting this convertible note or this senior convertible note put into place while still trying to protect the current investors of the company. All right, so as we have already talked a little bit about how Terawulf is going to be utilized in this strategic transaction, I'd like to go ahead and break down some of the market mechanics, go over some of the definitions, starting with some of the basics involved with this specific transaction. There were some requests for this type of information, so let's go ahead and break this down a little bit more. So let's start with a convertible bond. So a convertible bond is like a loan that gives investors the option to convert it into shares of the issuing company's stock. Think of it as a hybrid between debt and equity. So here's how it works. Let's first talk about the debt aspect of it. Just like a regular bond, a convertible bond has a set interest rate and a maturity date. The company pays regular interest to the investor, and when the bond matures, it has to pay back the full principal amount. So the equity aspect. Unlike a traditional bond, a convertible bond gives the investor the right to exchange or convert it into shares of the company at a predetermined price known as the conversion price. So the conversion price is usually set higher than the current stock price. So if the company's stock value goes up enough, the bondholders can choose to convert their bonds into stock and potentially make a bigger profit. This feature makes convertible bonds a compelling option for investors looking for a stable income with a chance for higher returns if the company performs well. So why would companies issue convertible bonds? Let's go ahead and get into that a little bit. So convertible bonds are especially attractive to companies in high interest rate environments, like what we've seen lately. So let's break down some of those key benefits. So for lower interest rates, since convertible bonds offer investors the chance to profit if the stock rises, companies can offer lower interest rates compared to regular loans. Deferred stock dilution. Unlike issuing new shares directly, convertible bonds don't immediately dilute or reduce the value of existing shares. This keeps shareholders happy because it maintains the value of their shares until conversion. So as I mentioned before, the Terawulf transaction has a maturity date of 2030 with an option to exercise earlier as of November 2027. Again, there's going to be no immediate dilution impact for the company's value for their current investors. However, if you look at the way that the company strategically bought back the shares, that buys additional time before you hit that break-even point on the share count again. And then with that capped call, again, that hedges the company and allows them to continue to grow to double the current share price before actually having to start that offering of shares. So let's look at this comparison chart of a convertible bond versus traditional bonds and stock issuance. So Terawulf, for example, recently issued that $500 million in convertible bonds to fund its growth in green infrastructure. By choosing convertible bonds, Terawulf could raise the funds if needed without paying a higher interest rate that would come with traditional loans. So again, this is a great option for a company that has significant assets or has significant forward growth, future growth. They're able to kind of put all that out there for investors and make this convertible bond look very enticing. So now that we've talked a little bit about the convertible bond, let's talk about the role of the conversion price itself. So the conversion price is critical because it determines when investors might want to convert their bonds into shares. Companies often set the conversion price above the current stock price, ensuring investors only convert if the stock rises significantly. This protects existing shareholders by preventing sudden dilution, which would reduce the value of their shares. Convertible bonds are also often contingently convertible. This means investors can only convert when certain conditions are met, like the stock price reaching a certain level or nearing the bond's maturity date. And as I mentioned, another way that Terawulf decided to kind of fight potential dilution with the rise in stock price is by using a call spread. So here's where it gets interesting. To further protect their stock, companies often enter into something called a call spread transaction alongside issuing their convertible bonds. A call spread is a kind of financial tool that helps the company offset the risk of stock dilution if investors convert their bonds to shares. Let's break that down a little further. So buying a call option. The company buys an option to purchase its shares at a conversion price. This means that if investors convert their bonds into stock, the company already has the right to buy the shares at that price, preventing a flood of new shares from hitting the market. Number 2, setting a cap price. The call spread comes with a cap price above the conversion price. This limits how much value the company can gain from the call spread, but also restricts how much dilution can happen. In Terawulf's case, they set a cap price of $12.80, which is 100% above the last reported stock price when this offering took place. This cap limits the impact on shareholders even if the stock skyrockets. So again, it's a great way to hedge their bet in terms of the company's fundamentals exploding. The share price goes off on a tear. There's not going to be an immediate dilutive impact because they have this call option that kind of helps pay for those conversion prices with cash versus stock. So let's go a little bit into Terawulf's convertible bond and call spread strategy. So walking through Terawulf's strategy as a real-life example of how these concepts work together. In October of 2024, Terawulf issued $500 million in convertible bonds with a 2.75% interest rate, a smart move to raise capital without excessive interest costs. They set a conversion price at a level encouraging investors to convert only if Terawulf's stock price performs well. To protect its stock from potential dilution, Terawulf then entered the cap call transaction. The cap price they chose was $12.80 per share, or twice the last stock price. And they also did stock buyback. They used $115 million to buy back their own shares, reducing the number of shares on the market and further stabilizing their stock. This comprehensive approach lets Terawulf access the needed funds while balancing investor interest and shareholder value. So who actually benefits from the convertible bonds? So there are two different types of investors. I mentioned this earlier on in the video that would want to go ahead and move forward with a convertible bond with a company. And the first one is a fundamental investor. These fundamental investors, they're drawn to the steady interest income and the potential of the stock upside. So who exactly benefits from these convertible bonds? Well, there's actually two different types of investors. As I mentioned before, I want to go ahead and talk a little bit in further detail about these two types of investors. The first is a fundamental investor. They're drawn to the steady interest income and the potential stock upside. So they're in it for the long haul. So they do believe in the company's fundamentals. They do believe that the company will bring value, which will then create a stock price increase. And you have the other type of investor, which would be a technical investor. So these types of investors, they often hedge their convertible bonds basically by betting on the stock movement. And sometimes they'll do short selling in order to profit from some of the volatility. So if they're not necessarily 100% behind the fundamentals of the company, they could still go ahead and offer them this secured convertible note or the senior convertible note, but they could go ahead and short the company. Go ahead and think that the company is going to be decreasing in value. They're going to make money as the company's stock price is reduced, as well as they're still going to be able to convert those shares at that current price. So they're getting the interest rate plus that minimum conversion price that was negotiated as part of that convertible bond, and they're going ahead hedging their bets in the terms of the stock price going down by shorting. So in the event that the stock price goes the other way, well, they're still going to be making money because they own that convertible note, which they can then use to basically pay for that short transaction. All right, let's talk about the pros and cons for using these convertible bonds and call spreads. As I mentioned earlier on in the video, I want to break down both the positives and the negatives. So let's start with the positives. So the first positive is going to be lower interest rates. Convertible bonds offer a lower borrowing cost compared to traditional loans. Deferred dilution. Immediate stock dilution is avoided, benefiting current shareholders. Third positive is going to be flexible capital. Companies can use convertible bonds for strategic growth, acquisitions, and other long-term goals without heavy upfront interest costs. Fourth, investor appeal. Convertible bonds provide predictable returns plus potential stock gains, making them attractive to a variety of investors. Now, here's some negatives to go along with these positives. Potential stock dilution. If too many bonds are converted, it can dilute existing shares, even with cap call protection. So I shared that graphic already. So even though the company bought back approximately 18 million shares, as that stock price increased, that conversion price is going to also be increasing. They're going to have to then pay the investor either in the form of cash or in the form of shares. So after that capped call is hit, anything above that capped call, the company has the choice of either going into their treasury to pay for that additional stock price increase, or they're going to have to issue additional shares in the form of dilution to help pay for that additional share price increase. The second negative is going to be market dependency. If the company's stock doesn't perform, convertible bondholders may feel the returns are low, especially with higher interest rates available in the market. So again, it's going to be important to look at the fine details in the SEC filing. What are some of the ways that the investors can exit or execute their senior convertible notes at an earlier date? So make sure, besides the PR, that you're reading through the SEC filings of any publicly traded company to ensure you understand all of the fine print behind some of these convertible bonds. And the third negative is a complex management. So managing the call spreads and other protective measures requires expertise, adding complexity and sometimes higher costs. So if you do look at some of the information behind what Terawulf did, their CFO actually took the reins on this transaction. So depending on how savvy a company's chief financial officer is, they may have to reach out to a different type of securities attorney or some person with extensive knowledge behind these types of convertible bonds and call spreads in order to make sure that they're getting their best interest in mind. So again, that's going to come at a cost of the company. So it's going to be important that the company that you're investing in has the right people that can make these calls. They don't need to continue to reach out to third parties, which can add additional cost to the company. So I hope that helps explain a little bit about these senior convertible bonds or convertible notes, as well as how these different call spreads are utilized, what type of investors would be interested in such things, but just kind of want to go over a couple of the key takeaways. So here's the bottom line. Convertible bonds and call spreads give companies like Terawulf a powerful toolkit to raise funds efficiently while managing shareholder value and investor interest. They're particularly useful in high interest environments, allowing companies to grow strategically without high immediate costs. But they're not without risk. It's important for investors to understand the potential for dilution and the dependency on stock performance, whether you're a seasoned investor or just getting started. Understanding these tools can help you make more informed decisions. And that wraps it up for me, folks. I hope you really enjoyed this video. Remember that this is for information purposes only. I do not provide financial advice. If you liked this video, please consider giving it a like, subscribe to the channel if you haven't already, leave me a comment, let me know your thoughts about this video, let me know what you'd like to hear about in future content. And with all that said, I hope you all have a great rest of the day, and I'll see you on the next one.